What's going on, you guys? My name is Zach Hartley, and in this video I'm going to walk you through the 5 different factors that go into calculating your credit score, and I'm also going to share with you the strategies that I use to keep my score above 800. Here is everything you need to know. Let's go. Okay, so your credit score is made up of 5 different factors, and I'm going to break them down for you here in just 1 minute. They're listed here on the left, but what I want to point out to you is that they are not all equal. Some of the factors are much more important, and the number one most important one is your payment history, followed by your amounts owed. Those 2 factors actually make up about 65% of your credit score, followed by the remaining 3 factors making up about 35% of your credit score. So it's really important that you focus on the areas that are going to give you the best return here, and let's dive into that. So number 1 is your payment history. This refers to, do you make your payments on time every single month? If you have a loan or a mortgage, that's going to be a fixed payment every month. But if you have a line of credit or a credit card, that is going to be a minimum payment. And what we're talking about here is, did you make that payment every single month on time? Because this is the largest factor. This is the most important factor when it comes to your credit score. And it's also the easiest factor to be really good at. And the strategy here is to just automate your payments. If you have a minimum amount that you need to pay on your line of credit and your credit card every single month, set it up in your bank account, go to your checking account and set it up to automatically withdraw the minimum payment every single month. That way you will never be late and you will always be on time, and it will be automated so you don't have to worry about it. If you feel comfortable, you should also do the same thing with any loans or mortgages you have, so that again, you will never be late and your payment history will be absolutely perfect, so it will help you build your credit score over time. Now, the second factor here refers to your amount owed, also known as your utilization rate, and this refers to revolving credit. So what I'm talking about here is credit cards and lines of credit where you have access to a certain amount of money and you can spend that money and pay it back, spend that money and pay it back. That is referred to as revolving, and the utilization rate refers to how much money you can spend and how much of that money you have already spent. So if you've spent $2,000 out of $10,000 on your credit card, you're at 20% utilization rate. And what the credit bureaus and the banks want to see is a very low utilization rate. You want to keep your utilization rate on a per card and per credit line basis under 30%, because that shows to the banks that you have the credit but you don't need it and you don't rely on it, because as soon as you cross 30%, it means that you're relying on your credit. That is a red flag and your credit score will drop because of it. So the strategy here is to figure out how much money you can spend on each card, what is the 30% maximum for you, and then to never go over that limit, and it is on a per card basis. So you need to make sure that on a per card or per line of credit, you are not going over 30%. And that way it will help show the banks and the credit bureaus that you have credit, but you're not reliant on it. And that way it will build up your credit over time. Now, the third factor here is the length of your credit history. And this is basically saying, how long have you had the credit for? It's kind of like a resume when you go in to apply for a job. If you've done that job for the last 5 years, you've got a lot of history and somebody can have a lot of confidence in hiring you. If you go into a bank and you say, hey, I'm looking for a mortgage, but you only have a credit card with 3 months worth of payment, well, there's not a whole lot of information for them to make an analysis on. However, if you had 3 credit cards that were 6 years old and you got a line of credit and a car loan and a payment, and they have a lot of information to know that you are a good person and you are paying back your debts and you have a good credit score and lots of great credit history, they're going to value that much more, and it is going to give you much more credit, and it's going to build your score up over time. And so the longer your credit history is, the more valuable it is to the lenders and to the credit bureaus. So the strategy here is to never cancel any of your old credit cards or lines of credit and just try and automate some payments on it. So if you have an old credit card, put your Netflix subscription on there and then go to your bank and set up an automatic payment so that it gets charged and used every single month. You get an auto payment that goes to it, and the credit bureaus see that you're still using the card and you're paying it back responsibly. That is going to be the best way to improve your credit history, but you should never cancel your old credit cards or your old line of credits unless the fees are just absolutely ridiculous. Now, the next one here, then the fourth factor, is new credit. So this is referring to credit checks and credit applications. It is not a good sign if you have a ton of credit checks on your credit report, because it means that you're consistently going out and trying to apply for new credit and new debt, and you're probably not getting it, which means there's probably an underlying problem there as well. And so when somebody sees and when the credit bureaus see a lot of credit checks, that is not a good sign. So you need to significantly, as much as you can, avoid hard credit checks unless you know that it's a credit card you are going to accept if you get approved on, or a line of credit or a loan, whatever it is. Do not apply for something if you're not 100% sure that you are going to accept it, and you need to try and avoid letting anybody do a hard credit check on you as much as possible unless it's actually required for a large purchase or something that you really need. Now, the best strategy for this one here is if you know that you're going to be applying for a mortgage or a loan or financing or whatever it may be, even just a fancy credit card in the future, you want to try and avoid any credit checks in the months leading up to that application, especially if it's going to be a mortgage. The last thing that somebody wants to see as they give you a $300,000 or $400,000 or $500,000 mortgage is that you're applying for credit cards and lines of credit. That is going to be a massive, massive red flag, and you want to try and keep this area of your credit report very clean before you go in and apply for any types of loans, because those credit checks will be major red flags for somebody that's looking at and considering giving you more money. Now, the last factor here refers to types of credit, and what this is talking about is diversification within your credit line. So somebody that has 5 different credit cards is not very diversified, but somebody that has 2 credit cards, a line of credit, a car loan, and a mortgage, that would be considered very diversified, and that person would be able to increase their score faster than somebody that had 4, 5, or even 6 credit cards. And so the credit companies, the credit bureaus, and the banks like to see multiple different types of credit rather than just a focus on one, which is usually credit cards. And so if you have 2 or 3 credit cards, I would recommend going out and applying for a line of credit, or go apply for a small loan, go get a car financing, go do something that can diversify your credit line a little bit to help you build up that credit. Now, this is not a major factor in calculating your credit score, so do not go out and buy a Lamborghini because you saw some YouTuber tell you that you should diversify your credit. That is not the right answer here. You need to be responsible with it, but keep it in mind when you go through and make these decisions of, should I apply for a 3rd credit card, or would a line of credit suit me better? Well, it would improve my credit a little bit more than a 3rd credit card would, so maybe that's the right answer here. Now, if you're interested in learning more about credit and more about strategies for how to understand your credit report, file a dispute, and improve your credit over time automatically, then definitely consider signing up for my credit building course. I just launched it a couple of days ago, and it is completely free. It's hosted on Skillshare, and the link is in the description to this video. I'm just going to give you a quick run through of what it looks like. So here we go. I have it set on 2 times speed, so you can watch it at whatever pace you want, but there's 15 lessons in here that will walk you through everything you need to know, from understanding your credit report all the way down to paying off your debts, filing your disputes, and a nice little summary and a project that will walk you through setting goals for your credit, how to build it, a payment planner, and everything you need to get that score up above 800. So if you're interested in learning more about your credit, definitely take a look at my course. I just launched it. It's completely free, and I would love to share it with you. It's only going to be free for a limited time though, so definitely check it out soon. And if you get any value from this video, remember to click that like and subscribe button. Good luck in your financial journey, and we'll see you in the next video.